Well, we're back here in the garden again today, and I have to report that the Westpac Melbourne Institute Index of Consumer Sentiment fell by 0.9% to 95.8. That's the lowest level since September 2020, and it follows that 4.2% fall that we saw last month. And last month, of course, the key factors behind that fall were inflation, interest rates, the invasion of Ukraine, high petrol prices, and floods. So this result could have been a lot worse, but there were some positives that supported the index over the month. The first one was the federal budget, another strong result on employment, and of course we have seen a fall in petrol prices in response to the budget initiatives and the lower oil price offshore. On the interest rate front, we saw a 9.3% fall in how people with mortgages feel. And that, of course, is really starting to bite in terms of the mortgage market. We also ask a question about the outlook for interest rates, and 70% of respondents now expect interest rates to go up over the next 12 months. 36% expect rates to go up by more than 1%. On the inflation front, we've seen a 5.3% fall in the question, is now a good time to buy a major household item? And I think that's reflecting the rise in prices that we've seen associated with transport costs in particular. That index is now 22% below its long run average, and it's fallen by 11% over the last 6 months. However, there has been good news with regard to the labour market. The outlook for the unemployment rate has improved again by 2.5%. That means that it is the second best result in terms of the outlook for the labour market since the mid-1990s. And last week, Westpac revised down our forecast for the unemployment rate from 3.75% down to 3.25%. And of course, associated with that will be a further lift in wages growth. This is the time of the year for the budget, and since 2010, we've been asking a question about the budget. And the question is the budget going to strengthen or weaken your finances over the next 12 months? Now, since 2010, we've only had 2 times, that was last year and the year before, when more people said improve your finances relative to those that said worsen. And this month was no exception. So we saw a 7% negative read on that. So 7% more people said worsen than improve. But actually that's a very good result, because apart from those 2 budgets during COVID when the stimuluses were extraordinarily generous, this is the lowest negative that we've seen. So in 2019, the number was about 8%, this was -7%. But between 2017 and 2010, when we first started doing this survey, the negative numbers have ranged between -17 and -55, with of course that horror budget in 2014. When we look at the confidence of various income groups, lower income groups were very positive about the budget. High income and also the older age groups are also quite positive. So it certainly can be seen to have been a successful budget in that perspective, given that it was, in terms of our particular measure, it was the best apart from those 2 very stimulatory budgets in 20 and 21. News on housing wasn't quite as positive. The time to buy a dwelling index went sideways, but it's still 40% below the peak we saw in November 2020. That, of course, is being weighed down by affordability issues, concerns about the price of houses, and of course the outlook for interest rates. And then we've also been asking the outlook for house prices. Now that index has been doing a lot better than the time to buy a dwelling, but that fell by 3.5%, and that's now well off its peaks. At its peak, 70% of respondents were expecting house prices to rise over the 12 months. Now that's down to a little over 50%. And in Sydney and Melbourne, where the indexes fell by 9% and 12%, the proportion of people expecting house prices to rise has fallen below 50%. And of course, that's partly reflecting the very flat market that we've seen in Sydney and Melbourne now for the last 3 months. Now, the Reserve Bank Board next meets on May 3rd, and we're expecting them not to change rates on May 3rd. But last week we did revise forward our timing for the first rate hike in the cycle. This was in response to the Reserve Bank Governor's eliminating the word patient from his description after the board meeting, and including a concept that said we'll be watching the data over coming months. To me, that's 2 months, and that means that liftoff is going to come in June, because we think the data, the inflation numbers and the numbers around the labour market are going to be very supportive of higher rates. I think the RBA has also been unnerved by the aggressive change in the attitude by the Federal Reserve. We're now expecting the Federal Reserve to raise rates by 50 basis points in both May and June. So our profile for the RBA has been brought forward and has been and the timing between moves has been accelerated. So for this year, we're expecting moves in every month apart from September and December. The rate to get to 1.25% by the end of the year, that compared with 0.75 before, and the rate to get to 2% by the middle of 2023. Our previous peak in the cycle was 1.75%. The main reason why we're expecting to see a series of rate hikes next year, 325 basis point hikes next year, is that we're expecting to see very, very strong labour market, the unemployment rate falling to that low 3% level, and wages growth being very strong. And that'll mean the Reserve Bank will have to continue to tighten policy in order to achieve its long-term inflation objectives. But the market, of course, has a much higher tightening point. They're expecting the rate to reach 3.5%. Our analysis of household debt situation suggests that it's not necessary to take rates that far. Thank you very much.